Lots of questions people have about policy loans. Policy loans are the key to cash flow inside of the privatized banking system. So let me go over a few things. First of all, it's called a loan, but it's a loan unlike any loan that you're typically used to. You're accustomed to structured loans. What that means is you borrow money from a bank for a car, for a house, or for whatever. They give you a payment book or a payment date. It gets drafted out of your account at the same time every month. It's a structure. If you don't make the payments on time, they come get the collateral, whatever the loan was for. That's not how these work, okay? These are unstructured loans, which means you can pay all of it back the next day or none of it back ever, okay? And that'll be explained more in coming videos. But the life insurance face amount over and above everything ensures that the loan will be repaid, even if you pay zero of it back, okay? So let me walk you through this. So a loan, quote unquote, a loan, is designated this way because of IRS codes 7702 and 101. Those two codes deal with the cash value treatment and taxation of the cash value inside of a whole life insurance policy or inside of a life insurance policy in general. So the cash value inside of this life insurance policy is then used as collateral. So collateral from the insurance company. So the insurance company will look and see what the value of your account is. And then as long as you can borrow up to about 95% of the value of your account. For instance, if you've got $10,000 in there, you can borrow about $9,500 out of it, okay? So the cash value does not ever leave your account. So the cash that you put inside of your dividend paying whole life account, or many accounts in most cases, none of that leaves your account. It comes from the insurance carrier, okay? So the loan comes from the insurance carrier. They charge about 3 to 5% interest. It varies based on carrier and based on time. It's very minimal as far as volatility. It stays steady based upon the Moody's Bond Index. And it's paid, that 3 to 5% interest is not repaid to you. It's repaid to the insurance carrier, because the insurance carrier is the one giving you the loan, okay? And that's on the lower amount. In other words, you can't borrow all the cash in there, so it's on a lower amount. Then you're going to get 4 to 6% interest, so a little bit higher than this, interest earned on your cash value on a higher amount. So you're earning more interest on a higher balance versus the loan is lower interest on a lower balance. That difference there is really important in your long-term financial security. So then you have uninterrupted compound interest forever. Because the money's coming from the insurance company and no money ever leaves your account. Let me repeat that. No money ever leaves your account. Because that's the case, it all continues to stay there earning and accumulating interest. So this is the key to escaping the finance trap. So the finance trap ends when you set up a privatized banking system. The finance trap, just a refresher real briefly, you can either borrow the money from a bank or lending institution and pay interest because they accumulated the capital, right? Or you can pay cash and then you lose the interest that you could have gained if your cash was kept in some kind of interest-bearing vehicle. That's called lost opportunity cost. Those are your only two options if you don't engage in privatized banking. You either borrow the money and pay interest or pay cash and lose interest. With loans set up to a properly structured privatized banking system that you should have, through loans you're allowed to escape that by using the insurance carrier's money. You'll never deplete your balance again. That's policy loans, an overview, IRS code 7702 and 101.